All right, all right, all right. Matt, the mortgage guy, we are live Monday, 6 p.m. Pacific Standard Time, just like every Monday, live mortgage broker Q&A, answering all your questions, mortgage related, housing market related, anything you want to talk about. Forbearance, you want to talk about silly articles like the one that was put out today where the housing boom is over, what that really means, what they were looking at. Happy to jump into it. Before I do, I've started a new thing where I'm taking notes every single week. If there's a question that I can't answer or I don't have the correct answer to, rather than make a guess, I'm going to jot down some notes. I'm going to talk to my processor. I'm going to talk to my production manager. I'm going to talk to my account executive, whoever I need to talk to get the right answer for you. So last week had a question about our solar panels that are leased calculated in your DTI. Had a good conversation with my processor, and we get the solar lease agreement, and it's got a kilowatt average. That kilowatt average estimates what that monthly bill is, and it's between like $5 and on the very high end, like $40 a month. So yes, it factors into your DTI. Is it very much, or is it like a deal killer or something that you should be concerned about? Very, very infrequent when it's going to be enough to have an effect, right? And so that's the answer on that. I think it was 2 weeks ago when somebody asked about the max number of applicants that you can have on an application. I dug into that one a little bit because I know that I've seen 6 and 7 people on a loan before, as crazy as that sounds, right? And so you can have unlimited number of applications on a mortgage application. But the problem comes when there's more than 4, the automated systems, desktop underwriter or whatnot, will not recognize more than 4. So it would have to be manually underwritten. Manually underwritten loans are, more laborious. I'm going to use that word. Sounds like it fits there. And you don't just get the approve eligible that you get from the automated system and everything's nice and easy. You got to do a manual underwrite. So while possible, a lot harder when you get more than 4 applicants. Not really that common, so it's not something a lot of you guys are going to worry about. But if you're putting 5 people together to do a loan application, just know it's going to have to be manually underwritten. The system won't recognize it. So thanks for joining me. For everybody that was here nice and early, I saw questions popping through before I even got started. And you know what? I don't know if those ones still show up, but I'll try to find them if not, or just ask the question again. Just like we do every Monday, I'm just going to start answering questions. If you guys run out of questions, I'll talk about the video I made for tomorrow, or I'll talk about anything that's on my mind in terms of the real estate market and whatnot. But if the questions keep coming, I'll just keep answering. And literally the last few weeks have been rapid fire. 2 hours of answering questions to the best of my ability. And like I said, I will take a note. If there's a question I don't know the answer to, I'll get the right answer. And then beginning the next live stream, I'll go ahead and answer that. I think that's a good idea rather than just trying to guess, right? Esther and Jimmy Andrews, thanks for joining. Appreciate you guys being on. This is a really good question. And it's, is it true that if you're doing a cash out refinance on a property, you're waiting to start your new job, you'll not be able to close your loan until you start your job? This is a tricky guideline. And if you're talking about a conventional loan, which a good majority of loans today are conventional loans, here's what the guideline says in terms of a new job. And this can be cash out refinance, rate and term refinance, purchase. It can be for any loan. If you have a job offer letter, and your salary is going to be $8,000 per month, $96,000 per year, we can use that income to qualify you for any of those loans up to 60 days prior to your job starting. So your job's starting on September 1st, and we want to close a loan on July 27th. That's all good. You're starting that job within 60 days. We can use that income. Here's where it gets weird. Your specific question talked about we can't close it until you start your new job. If you did start your new job, now we need a pay stub. And so if you're within 60 days of starting, you definitely don't have to start. So the answer to your question is no. But if you do start, we need a pay stub. It's kind of weird, right? We close a week before you start your job, all good. we're trying to close 2 days after you start. We can't because we need a pay stub. But that's just how the guideline reads. Multiple lenders I've talked to, that's how they look at it. And so that's how that works. Keep in mind, if it's any sort of hourly income, variable income, commission type income, none of that stuff is going to work for starting a job and using that income right away. That 60 days prior to your job starting where we could use the new income, I can't remember what they call it. There's a specific word for it where it's not projected income, but it's, I don't know. I forget the word. That's only going to work on salary positions where we know exactly what the salary is and what the pay is every single month. So hopefully that answers your question. It's definitely one that's interesting. I did some loans for some people that were relocating, and you're an eye doctor from New York, you're moving to California, you're not starting for another 65 days. We can close your loan 5 days from now, as long as you're within 60 days of starting with that job offer letter. All right, Cali boss. Thanks for joining us. Appreciate having you here. Do we think we'll see more inventory once the rent moratoriums end in September and landlords wanting to sell? If the rent moratoriums end, I don't know if that's going to cause a lot of landlords to want to sell, once they can finally start collecting rent and once they can evict tenants and put better ones in. Maybe it will. I think we're going to see inventory tick up even, in spite of what's going on with the rent moratoriums in the rental market and whatnot. I haven't really seen a mass exodus of real estate investors in the residential space, or even the talk of it, where we think that there's going to be a bunch of people selling. Some landlords are absolutely fed up, have already sold, or they've sold it now, and the person buying is gung-ho enough, or they're brave enough to buy an occupied investment property where they may or may not be able to collect rent. So I don't think so, is my answer to that one. E. Horvat. Hi, Matt from Minnesota. What's my Minnesota accent? Sonoma County. We're neighbors. You're very close to me. What is your experience with home style loans? Oh, you're talking about Fannie Mae home style. That's like a renovation loan for anybody who's wondering, where similar to FHA's 203K, you can finance some of the repairs into the loan. And I'll give you my honest feedback on this because all I know to do is be honest. Both of these loans, home style, which is a conventional type, and FHA 203K, both renovation loans where you can finance the renovations of the property. Not very consumer friendly, if that's a good word. Expensive, higher rate, restrictive, where you have to use like specific contractors for the work. Has to be, done by them and put through a process and all that. I don't know. Anybody I've talked to, anybody who I've known that's gone through these types of loans has either regretted it or just said, it's not a process I want to do over again. Depending on how much work it needs. If it's in decent enough condition to get financing through a conventional loan, you're probably better off buying it with a conventional loan and then just with 6 months, 9 months, 12 months of work and, self-financing it, whether that's a Home Depot card or whether that's something else, it might be a better plan than taking a loan with a lot more fees, with a higher interest rate, with all that stuff baked into it. Because let's say that loan has an extra $5,500 in fees and you take a rate that's 3/4 higher than the rate you're going to get. In the first year, between excess fees, excess interest, you might be paying $7,000 or $8,000 more, when if you did a conventional loan, got the best terms and used $7,000 or $8,000 towards the $25,000 in repairs you want to do, you might be better off with the latter. That's probably what I would do if I was in your shoes. If it's in such bad shape that it's like ineligible for financing, then you just got to negotiate a sweet deal with your landlord, so that financing it with hard money or financing it with one of these home style or 203K loans makes sense to you, because you're going to pay a lot for it. No doubt about it. It's going to be expensive. Linda Gomez, hello, 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 and hi to the community. Appreciate you being back. Appreciate you being back, Kevin. Loyal dude here every week. Oh, my man, Jonathan, good to see you, brother. My real estate investment goals this year, coming year. I've got pretty, what do you want to call it? Conservative goals. I've got a lot of stuff going on with my business. I've got a lot of stuff going on where with a coach I've been working with for years, I set goals for business, for family, for investing, for all of it. I've realized that any real estate that takes energy and effort and focus away from my business is not very smart move for me in this point in my career, where I've got a mortgage business that's blossoming, right? 50, 60, 70% year over year increase in production, right? And so with all that being said, the stuff I'm investing in is super passive. I've got friends that are doing ground up construction, multifamily, ground up construction, hotel, things like that, where it's a syndication where I can put my money to work without me having to really be involved at all, literally wiring money. And so some of that going on, a commercial building for my mortgage company is likely something that's going to happen over the next 6 months to a year. Possibly one piece of real estate, single family duplex, 3 to 4 unit, doesn't really matter to me. When I've got criteria for investing, it's a cash on cash return thing. It's how much of my time, effort, and energy is going to be needed on this thing. And so sometimes that works single family, sometimes it works triplex. I'm not really picky with those, but that's it. Buy one cash flowing piece of real estate, buy one commercial property, and invest some money in a syndication. The syndication money, that one's already in the works. All right, Merrick, I appreciate you. Hit the like button. Man, I'm glad I got all you guys on the team. It looks better when it comes from you versus me just asking for people to smash the like button for the YouTube algorithm to get more eyes on here. One of these weeks, I think it might be in August. I think in August, we're going to be able to get to 100 people watching at once. Usually the half-hour mark, 40-minute mark, we'll get 60 people or so. And so the questions will fly. The more people we have, the more questions that will be asked and the more feedback we can get from the people. I like that a lot sometimes, where somebody asks a question and we're going to get a crowdsourced answer, right? Thanks for being here, Jonathan. Appreciate you. Jennifer Sabino, thanks for joining. Aaron Wallace, man, see, this is why this is the best ever, because questions that I don't even think about asking myself come up. And this is a really good question. Do you see the conforming loan limit going up in 2022? If anybody doesn't know, conforming loan limit is $548,250. In some counties, and a lot of counties in California are high cost counties, you can go to 598, you can go to 622, you can go all the way up to 822,375. And it's still a conforming loan before you get into the jumbo space. But this 548,250 number, without a doubt, Aaron, like I hesitate to say 100% guarantee, but home price appreciation is for sure there, right? Homes have gotten more expensive. I can't remember the index that they use, but they use one of the indexes to see, like, have home prices got more expensive? Do we need to adjust this? And they're going to use a number from that. I wouldn't be surprised if it went up like 7 or 8%. So let's do the math. 548,250 times 1.08. I wouldn't be surprised if that loan limit's like 592. That would be a 8% increase. 592, 110. Let's just guess right now. 592, 110. I'm saying it here, July of 2021. New conforming loan limit for 2022. And they usually, I think, if I remember correctly, late November, early December, they're going to announce this. And then lenders are going to say, we're already honoring next year's loan limits, because they'll just start taking those loans in, and those $580,000 loans, they'll hold on to it for 3 weeks and then deliver it to Fannie Freddie once the loan limits are already up in 2022. Catch me? Cool. Theo B. Oh, see? I appreciate you, Theo. GreatMortgageBroker.com. If you fill out a form, you're going to get contacted. If you don't get contacted, I'm going to be in there busting heads. That's if you're outside of California. GreatMortgageBroker.com. Theo B had a sister reaching out, and apparently we didn't get responded to. So we had to jump in. We had to say, this is my guy Theo B and his sister. You got to take good care of him. And here we are. Refinancing now, great rate. Yeah. I'm going to connect you with a great mortgage broker in whatever state you're looking in. Trust me when I tell you, from the top down, I know the company and how they're going to do, how they're going to treat you. I know that working with a mortgage broker, you're going to get some great terms. So appreciate you sharing that, Theo. Thanks for joining. Okay. Is crypto an acceptable payment form of asset for down payment reserve requirement for rental property? Well, here's the thing. It can't be, it's got to be liquidated. Just like if you had Tesla stock, we could use that for down payment. You would just have to pull the Tesla stock. You'd have to liquidate it, put it in your bank account. If you've got 60,000 you want to use towards a down payment of a rental property, and it's sitting in Coinbase in Bitcoin, we all know that cryptocurrency is volatile. 60K today might be 34K 3 days from now. So it is an acceptable form of asset for a down payment, but it has to be liquidated. And then when you're just going to show, here's the money that was in Coinbase, here's me liquidating it, here's it back in my checking account, savings account, wherever you liquidate it to, right? So thanks for joining, Ressa. Good question. It's funny because I haven't heard a lot on the lending side. I remember as early as like 2017, 2018, there was a lot of talks about this. How are they going to source it? How are they going to treat cryptocurrency? And it's only more popular, more widespread, more used now. And I feel like mortgage guidelines, they haven't been talking much about it. Theo B, great question. Traveling nurses. This is like inconsistent paychecks. You're right. And really the key word there, Theo, is variable. Their pay is variable, where some months it's $9,200. The next month might be $4,700. The month after that might be $6,700, depending on what part of the country they're working in, how much they're getting paid, how many hours they're working, all that other stuff. And you can kind of put this all into one bucket and think about it all as the same thing when you're thinking about mortgage qualifying. If you have variable pay, lenders need to see a 2-year history because they need to be able to average something, whether it's commission and you're working some commission job or you're doing some sort of sales, whether it's an hourly job where some weeks you get 56 hours, some weeks you get 32, some weeks you work 44, next week you work 24. If you see any sort of fluctuation in your pay, rest assured the lender is going to look back at a 2-year history, and basically they're going to do an average, and they're going to say in 19, you made 60,000. In 2020, you made 64,000. And then year to date in 2021 through the first 6 months of the year, you've made 36,000. So that 30-month average is X. And more often than not, They want to see an uptrend, right? They want to see it go 60, 64, on pace for 72. They don't want to see it go in the other direction. If it's more than like a 10, 15% decrease, you're going to have some answering to do. Granted, 2020, a lot of people saw a decrease. COVID affected a lot of people in a lot of different industries, so it's not a deal killer. You're going to have to answer to it. You're going to have to give them a good reason for seeing the decrease in income. What's up, Joey? How you doing, man? Yeah, it's I'm psyched about it too. I've got 11 videos recorded, and I've got the last 3 with my editor who's going to edit those. All 11 videos. I think Zuber's already got 8 of them up. And so if anybody's not knowing what Joey's referring to here, my buddy Mike Zuber, One Rental at a Time, is his YouTube channel. Every Wednesday we get together, we chat real estate. We have a lot of fun talking about real estate investing, talking about mortgage, talking about all kinds of different stuff. He's got a book he wrote. He's got a course, One Rental at a Time. He's got a community. And within his course, he's going to insert these 11 videos. Sometime in August, I am going to release this course as a standalone course through Teachable. Somebody on my team is gonna do all the uploading and get that handled for me. I'm still trying to figure it out. I think it's going to be as inexpensive as I can make it, where I still make it enough, because I really think it's not like I need any extra dollars. I think that if somebody invests $97 or $88 or whatever the heck they invest, they're more likely to really do the course, right? If you give it away to everybody, people are less likely to sit through 11 different videos. And so I've never regretted any dollar I've spent. I think it was a Meet Kevin course, Graham Stephan course, a Chandler David Smith course. I might have bought something from Ryan Pineda. I'm not sure, but all these YouTube guys, I've bought the One Rental at a Time course. You feel more obligated to do the work and work through the course when you spend real money that you've earned on it. And by doing so, you get more out of it, right? And it helps you. And I spent some time trying to make sure that these 11 videos are going to actually impact somebody to where they're going to save 10x their investment, or they're going to be knowledgeable enough to really make sure they get the best deal, which, on a mortgage transaction, even if it's only one, it can be thousands of dollars. And so, that's coming sometime in August. Got to get the last 3 edited, got to put them together, got to get it on Teachable. I don't even know how to do all that stuff. I'm going to figure it out though. Or somebody on my team's going to figure it out. Gone viral. Good to see you. By chance, do you know how much money the Fed prints every month? I do not, but a lot of other people are on here. I'd love to hear how much does the Fed print? It'd be interesting to know. I mean, maybe somebody can even find an answer online. Maria. Thanks for joining again. Thanks for the welcome back. Last week I was in New York. I probably didn't talk about it a lot because I still did my live, but I spent Monday, Tuesday, Wednesday in New York last week. And Wednesday, myself and 75 other mortgage brokers joined United Wholesale Mortgage, a bunch of their executives, celebrating National Mortgage Brokers Day. 12 of us got to ring the closing bell at the New York Stock Exchange. It was cool as heck being inside the stock exchange. And it was really a cool day. Just trying to spread the message about how using a mortgage broker is the best way to do a mortgage. And it was cool experience. Been looking since April, outbid several times. No, it's coming, Maria. I think that More inventory's coming. It's gotta be, I mean, I'm not sure exactly. I think you're somewhere in Southern California. It's gotta be less competitive than it was in March, April, May. In my market, I can tell you with absolute certainty it is. For sure in Northern California, less competitive than it was then. Sure, people are still bidding above ask. Sure, it's still competitive, not as competitive as it was back then. So keep trucking. Something's coming. You're gonna get in contract. I can feel it. Then you're gonna come here. You're gonna share it with everyone. We're gonna be excited for you. People are gonna be motivated to go out there and put in offers and get a win for themselves. Joey. Yeah, Mike's course is great because it's simple. I mean, real estate investing doesn't have to be incredibly hard. One thing Mike does well is just reminds people to do the work, right? I'm trying to remember Chandler David Smith's course. I like that kid a lot. I say kid for anybody who's younger than me because I'm going to be 41 next week, so I'm an old man. I don't remember Chandler David Smith's course. I remember it being good. I like that guy. I follow that guy a lot. But yeah, both of those courses are really good for sure. Yeah, if you can get a smoking deal and you can get a conventional loan, I would do that. And the 75K in work, maybe what I would try to do somehow is 500K loan. If it's your primary, put 3 or 5% down, even if you have more. Spend the money on the 75K in work, get it dialed in. And then if you're getting a smoking deal, like it sounds like you are, maybe it appraises for 800,000 after the work's done. Then you do a refinance, a cash out refinance to 600 or 640 and pull out all the money you put in, maybe plus a little bit more. And then you're in the deal, nothing. All right. I can answer this question honestly because I am a lender that knows that it can be hard for you to get a loan under $100,000. It's a couple different things. One, lenders get paid on loan volume. So an $80,000 loan is 1/5 of the pay they'll get on a $400,000 loan. So there's that you're dealing with. Other thing that has nothing to do with how much they're getting paid is that there's a bunch of guidelines and stipulations in place where your fees cannot exceed a certain percentage of the loan amount. And in order to pass these tests, to have the loan deliverable to Fannie Mae and Freddie Mac, is hard on those small loan amounts because a lot of the stuff is fixed. Like the appraisal is going to be a fixed cost. Title fees, fixed cost. A lot of lenders, they got a 1055 flat fee, fixed cost. So on a $400,000 loan and you got $3,000 in fees, like no big deal, right? It's never going to exceed that threshold of, fees. But if you got a $60,000 loan and there's $3,500, $4,000 in fees, now all of a sudden you're getting to a place where it's 5, 6, 8% of loan costs, and it's going to fail that specific test where it's got to be less than a certain amount of loan costs compared to the loan. Is inventory still picking up where I live? It hasn't hit yet. Maybe you said maybe you meant to say if. Good to see you, Zita. Thanks for joining. I appreciate you. I appreciate you following. I appreciate you referring your friends to follow, all that other stuff. I'm not sure what market you're in. Let me try to think. But yeah, it sounds like you're saying it hasn't hit yet. Yep, that's good. You're right, Linda. It's coming. And you know what's going to happen, Maria, is you're going to find the right property. You're going to be glad you didn't get all the other ones. It's all going to work out just according to plan. I mean, and I don't say that to be cheesy. I say that because I deal with hundreds of buyers every single year. And for as frustrated as they get when they don't get something accepted, More often than not, they find a home and they're like, oh my gosh, I thought the last home was a perfect home. I thought 2 homes ago I really wanted that home. I'm so glad I didn't get those 2 now because I got this one. This one is the one. Uruguay. Hi, Matt. Thanks for all your help. Your advice is awesome. Are you starting to see more contingent offers? I am. That's a good question. I've got a couple out right now with clients that are contingent on their home selling. You still want to be in a position where your home is in contract that you're selling. Like, it's not like just contingent on your home selling and you just got it listed or you haven't even got it listed. Like, that's still going to be a hard sell. But if you are contingent on your home selling, but it's already in contract, you've already removed contingencies, you've got a shot. And 3 or 4 months ago, in a lot of places, it would have been honest advice to say, like, if you're contingent, you have no shot. Now you've got a shot. It's just another reflection of the market is still competitive, but not as competitive as it was 3 or 4 months ago. All right, Jose. This question right here is a common question. I love that you asked it. I want to really spend 2 minutes so that people hear this, they understand this. When you refinance your property, you do not get hit with a reassessment of taxes. When you buy a property and you buy it for $1.4 million, it gets reassessed upon sale. And you don't get to assume the old property taxes that the last people were paying just because they bought it for $750,000 in 2011. You pay the taxes based on the $1.4 million purchase price. Then the home appreciates. It's worth $1.9 million. You do a refinance. A lot of people's concern is like, I don't want this thing to be reassessed. That appraisal is not going anywhere near the county assessor's office. There is no reassessments on refinances. I repeat, no reassessment in your property taxes on a refinance. The only time your property gets reassessed is upon a sale. And so feel free to refinance freely without the fear of your property taxes going up. They do incrementally go up every month, and that's just how counties do us because they want to get their increased revenue for whatever the heck they're spending that money on. But it's not getting reassessed because of a refinance. I can promise you that. Very common question, very good question, very important question, because paying taxes on another $500,000 would be very expensive. So yeah, thanks for that question. If anyone's curious, apple, lemon, ginger, and beet juice. That's how champions are made right here. Fresh juice from Pressed Juicery. Not sponsored by them. Hey, Matt, do you think by now mortgage rates have fully included the adverse market fee removal? You seeing mortgage fallout? So for anybody wondering about that adverse market fee on refinances, there was a 0.5 point of cost baked in across the board to all refinances. And last week, they announced they're removing that fee. They announced that they're removing it as of August 1st. But the great news is every single lender I work with, every single one removed it before then, meaning that the loans that I submitted last week had no adverse market fee included. And when you say they have fully included the removal, that happened like automatically. On your rate sheet, when I price a loan as a lender, it will say, there's a 0.5 point hit because it's an 80% LTV. There's a 0.5 point hit because it's 720 to 739 credit score. That 0.5 hit adverse market fee is just not there anymore. So everything literally instantaneously got a 0.5 point better in price. Again, for people that think that means it got a 0.5 point better on rate, no. It's a different thing. A 0.5 point in rate did not happen. 0.5 point in price, meaning $300,000 loan. If it cost you a point for a certain rate, then it cost you $3,000. that went down to 1,500. It went down by 1/2 of a point. It really equated to about 1/8% on the rate. That's already incorporated across the board with everybody. All right. I'm not saying this, but my buddy Jose Sahagan is saying this. You guys got to hit the like button. It's just part of the program. And I appreciate the heck out of it. Kia Lee, hello from Sacramento. Thanks for joining. I like having some fellow Sacktown folks. You know where to come if you're looking for a loan. We're happy to help you. All right, I'm going to come back to you, Theo. Let me skip ahead to Kia's next question because I saw it. How are interest rates for investment? My friend's friend refinanced through Quicken Loan and got 1.99 for 10 years with no closing costs. Well, they got that rate on a primary residence. That wasn't an investment property. I can promise you that. I'd eat my left pinky. And I can promise you another thing. If they got a loan with Quicken, they didn't get the best rate because 99.2% of the time, a mortgage broker can take the loan somewhere else besides Quicken and get a better deal. But yeah, 10-year loans, depending on, credit score, depending on loan to value and all that stuff, you can get a pretty sweet deal on a 10-year. I'm going to look at that real quick just because I want to see something. I want to see about a refinance on a 10-year. With rates being as cheap as they are, who the heck wants a 10-year loan? I mean, I guess some people do. Some people, it's like, let's get this thing paid off. That's number one priority. I want to pay the term. Yeah, it's about where we're at. 1.99 with no cost. On an investment property, you're never getting in the ones unless you pay a ridiculous amount of fees, which you don't want to. But you can buy an investment property on a 30-year fixed, which you probably want to do an investment property if you're looking for cash flow, and get that in the low 3s, which is good long-term money. I can tell you that. All right, Theo. Following up on Race's question, I think Race asked about Bitcoin, right? What else can be used for reserves besides cash in the savings account? Well, if you're talking about reserves, let me see if I can find Race's question. If you're talking about reserves, it's different than down payment funds. I think she was talking about down payment funds, but let's pretend like you're talking down payment. I mean, you can use it from a stock brokerage account, that crypto account, your savings account, anything. If it's in some sort of investment that's volatile and moving, it's got to be liquidated first, right? And we got to show a 2-month history of those accounts before you can use it. If you're talking about reserves, it's similar, but reserves is like not money that's coming to the down payment. Reserves is just money we want to see in the bank just to know that if stuff hit the fan, you'd be all right. And that's similar. That can be in like a 401k. That can be in, stock account. That can be in all kinds of stuff. I don't think I've ever seen Bitcoin used as reserves. Bitcoin as reserves. I just asked myself a question for next week. Thanks for prompting that question to myself. All right, Armando. Is it possible to complete 2 mortgage transactions concurrently? Looking to refi my primary and purchase an investment property with strong financials. How realistic is this? I can tell you, Armando, that it's more common than you think. And I've got a few people doing that exact thing right now. it's a good idea. Let's say that you're doing a cash out of your primary and you're using those funds to put 10% down in a second home. Or like in your case, you're also buying an investment property. You may or may not be using the funds from the refinance of your primary, but whatever the case, if you qualify for both, you qualify for both. It doesn't matter if you do one first and one second. It makes more sense to do them at the same time because all the documents you're going to provide, last 2 months bank statements, last 30 days of pay stubs, most recent 2 years of W-2s, all the other stuff that you're providing, I'd rather provide it once. You know, mortgage transactions aren't that terribly difficult, but if you can do that one time versus twice, you know, and have to get the second month of pay stubs when you do the next deal, and then get another month of bank statements because you're doing the next deal the next month. Like, do it all in one shot, and there's no reason why you couldn't or shouldn't. And with strong financials, it's very realistic, and it happens all the time. I've got at least a couple that are doing that right now. All right, Doug, very good question. All these reserve questions. Most lenders in this scenario, if it's an IRA account, are going to use 60% of that account for reserves. So let's say, for anybody who doesn't know what reserve funds are, you have a primary residence, you've got 2 rental properties, and now you're buying a 3rd rental property. When you get pre-approved, the lender says on the 3rd rental property, you're going to put down 20%. That's great. That's $80,000. We also want to see 6 months of principal, interest, taxes, and insurance, PITI, on those 2 other rental properties. And so we want to see another 30,000 in reserves. Those reserve funds are just money you have in an account. You're not going to bring it to close, so it doesn't have to necessarily be liquid. You just have to show it in an account. In this case, in a Roth IRA, most lenders are going to use 60% because there might be taxes, there might be withdrawal penalties, right? And so you couldn't necessarily liquidate it and get 100% of it out. So most lenders that I use are going to use a 60%. So of that 200, 120,000 can be used as reserves. Unless you have a lot of real estate holdings, 120,000 is probably plenty. Jennifer, why conventional is more liked than FHA? And please, what are today's rate? FHA, 30 years. Conventional is more liked than FHA because if you've got good credit, the mortgage insurance is less. It doesn't have upfront mortgage insurance. If you borrow $400,000, conventional and FHA is going to charge you 1.75% upfront mortgage insurance premium. That upfront mortgage insurance premium of 1.75% is $7,000. It gets tacked onto your loan. Also, the mortgage insurance that's on that FHA loan never falls off. FHA loans that are written today, it was different in the past, but the ones that are written in the last 5 years, the mortgage insurance cannot be removed. You have to refinance if you ever want to remove it. And so for the upfront reason, for the MI never being removed, those are the 2 major cons of FHA. If your credit is not so great, FHA is more flexible. Their interest rates are great. Their DTI goes a little bit higher, so you might qualify for a little bit more. There's some cons to FHA, but there's also some pros. So don't necessarily want to just discount FHA altogether. But you asked about the rates, so I'll give you the rates. When I typed in my price or FHA, it said FHA YouTube. So maybe I've done this before. A par interest rate without control plus. Par interest rate without paying any points is 2.36. You want to see, Jennifer? I will show you. You ask for it, you shall receive. So this is a $400,000 loan with 3.5% down FHA. So you will see 2.36. This is the price down the middle. $0.00. 1523 is the principal and interest. So on 400,000, you've probably got taxes and insurance of, let's call it $400 a month. Maybe slightly more, maybe $450 a month. So that's principal and interest. That's the mortgage insurance. So that's $1,793 plus, let's call it $450 in taxes and insurance, depending on what state you're in, what county, it can vary, but $2,200, $2,250 total payment. You can go up here to 2.75 and get $4,800 in lender credit. And this is something that's been more popular lately, I think, is you take it 2.875, you get 6,000 in credit, you cover all your closing costs. You're not going to be in this FHA loan that long. Sure, you pay an extra $100 a month, but you only pay it for 2 years and then you refinance out of it. So you paid an extra $2,400 in payments, but you saved $6,000 up front. Sweet deal. I don't think you ever go down. I don't think you ever pay points to go down to like 2.125. That would just be silly, right? Pay all that money up front to save $50 a month. No bueno. All right, remove. I'm back. Thanks for that question. It was a good one. And you ask, you shall receive. The real one. Thanks for joining. Can you refinance if you owe $380 and your property is now worth $420? You certainly can. You're going to pay mortgage insurance, and it's going to be based on credit score, loan to value, all that stuff. We'll get an appraisal, right? And it's in that case, maybe with the fees rolled in and whatnot, your balance on the new loan is $386. In my head, I know that's going to fall somewhere between 90 and 95% loan to value. And so you're going to pay mortgage insurance, but you can certainly rate and term refinance. You can't do a cash out refinance. Mona. What market are you in, Mona? That's the first question. You notice sellers are getting bold. They're pricing homes well over the Zestimate. Well, first things first, Zestimate doesn't necessarily mean much. I'd be interested to see. I've seen on Zillow, once you post for sale with a price, like that price affects what the Zestimate says. So it's one of many points in their algorithm that may or may not be very perfect. I want to know what market that is, and I wonder what it sold for. If it sold for $550 or it sold for less, because it could sell in one day, but it might not necessarily sell for that high. All right, good luck in LA County. You're going to report to us soon, Maria, with a accepted offer. Yo, you can't do it on Android? It's just on iPhone? All right, so you could afford the higher fees, but if it's stuff that can't get financed, then all good. Do the home style loan. Just contact someone that's a pro at it. I'll be honest with you. I'm not a pro at home style loans. I haven't done a lot. What is this in reference to? Competitive. Is that code language for fraud? I don't know what that's referring to. Somebody's got a rampant appraisal fraud. You have to enlighten me, bro. What is this competitive? Is that code language for fraud? The only way you get approved, thanks for joining, Nicole. It's a great question. A lot of people that are self-employed are having trouble getting financing. And If you're self-employed and you've been self-employed for more than 5 years, we can use 1 year tax returns. You're going to have to prove, show a business license, something that's going to say, yeah, I've been in business since 2014. CPA writes a letter, says they've been, filing taxes for you. You've been self-employed since then. But that's the only way we can just go use 1 year. LP, loan prospector, the automated underwriting system will allow for 1 year if you've been self-employed for more than 5 years. And it is net. You're asking if it's gross or net. It's always net. And that's another thing with self-employed borrowers. You might have really high gross, take in $372,000. If you have a bunch of legitimate write-offs, and they're legitimate, I'm not questioning them, but if your bottom line is $12,000, you can't get approved for financing. So it's going off your net number. If anybody sees houses prices falling, you let me know, because I haven't seen them. But why buy a house when prices are falling? I don't think they're falling. They're rising at a slower rate than they were rising before, but 40 miles an hour is still in drive. It's not 90 miles an hour, but you're still driving forward. So that's what we got right now. We got a slowdown in home price appreciation, meaning home prices aren't rising as fast as they were in the past, but they're not necessarily falling, at least not in any markets I'm looking at. Are sales to a VA buyer harder to close? Seems to be common thought that VA appraisers are more strict and slower. This is a great question, Joey. And, truth be told, there's a few more things that need to be done on a VA loan. You're going to have to get a clear pest inspection. And, on an older house that's got dry rot and things of that nature, it's going to be a little bit more work than a conventional loan. That's just the honest truth about it, right? But the appraisals, I don't really think that they're a lot stricter, right? They're looking at condition with maybe a little bit more fine-tooth comb than a conventional loan, but this is a tough one, man. I mean, I root for VA buyers, and we all probably understand that like veterans that are eligible for VA loans are as deserving as anybody for a great loan and to get an offer accepted on a house. When a seller's presented with equal offers, one conventional, one VA, they more than often go with conventionals because like they're not going to have to fix dry rot. They're not going to have to do some of the repairs that might be required on a VA loan. I mean, that's just the truth of the matter. Only $15K away from being able to pay cash for a home that lenders can't provide a mortgage for. Fall into their requirements. What are my best options to cover this gap? Personal loan. If this is a place that you're going to buy cash, rehab, and then pull money out once it's financeable, I would find some private money and say, hey, listen, here's my plan. I need $15,000 from you so I can close on this house. I'm going to do X, Y, and Z. I'm going to refinance out this much money. I'm going to pay you back. That's probably your best bet is a personal loan that you might give somebody some terms on, pay them 6, 8, 10% interest. Man, John, if I knew this, dude, I freaking wouldn't be on YouTube right now. I'd be on a beach with my family, just selling my crystal ball predictions to everybody. I do not see rates getting down to 2% or below. I really don't. There's a bunch of conspiracy theory folks out there that are talking about, I don't even know what they're talking about. They talk about like stuff that's way above my head. Either that or either I'm crazy or they're crazy or a little bit of both. somebody told me there's going to be a 30-year fixed at 1%. I wouldn't hold your breath. Here's what I would do, John. What are you being offered today? 2.625, and that's going to save you $300 a month. Do that loan. If by some act of the highest beings in the world, rates get down to 1.625, then refinance again. But I would not delay a refinance that makes sense right now in the hopes that rates go lower. That would be silly. I made a video a while back on like the cost of waiting. And let's say that 2.625 is what you can get today and you don't do it, even though it's going to save you $300 a month. You wait 7 months. So you basically burn $2,100 in the air. And then 7 months from now, rates are worse. Then you're really in a bad spot, worse spot. But let's say rates are better, 2.5%. Okay, well, you waited 7 months. You basically lit $2,100 on fire because you didn't save $300 a month between now and then. But you got 2.5, and you're saving an extra $17 a month. How many $17 a month do you have to save to recoup that $2,100 that you lit on fire? I'll tell you right now because I got a calculator. 123 months, 10 years. Don't wait. Final answer. Kia Lee, yes on primary. All right. Thank you for referring your friend. She's looking to refi. If she's in California, I'm happy to help. If not in California, then I'm going to give them a little bit of, where'd it go? That. Little bit of that greatmortgagebroker.com. That's where they can connect with somebody who's outside of California. All right. I don't have to agree with everybody. And Coolio, I hope you understand that I respect you. And I'm not going to say this to be, contrarian, but your comment, as a well-known economist said, if you have to borrow for 15 or 30 years, you can't afford it, nor is it affordable. I know plenty of people, and myself included, I could put my primary home right now on a 5-year term, and I could afford it and pay that payment. But knowing what I know about a government that prints trillions of dollars and future inflation that is inevitable, why in the world would I not want a 2.5% 30-year fixed as a hedge against inflation? And so, I'm choosing to take a 30-year loan. And it's not that I can't afford a shorter term or that I can't pay it off in a shorter amount of time. Love me some 30-year debt. Give me more of it. If I could take $2 million at 2.5% on a 30-year fixed, I'd borrow it. I'd go put it to work. I'd earn 20% on all of it. And I'd have so much money to give away to so many good causes. It would be amazing. V. Quez, you did not miss me. I'm glad you're here. I go at least 90 minutes on these things, sometimes 2 hours. So, at 58 minutes in, we're just getting warmed up. Don't be surprised. I'm still young. I still got it. I can go for at least 90 minutes. Yes, sir. Oh, this is what I love to see right here. I'm going to screenshot this right here for the team. My team deserves all the praise. They're the best in the business. The best in the business by a long shot. So I'm going to screenshot this. Where's my thumb? Thumbs up. All right. That's so I can send it to my team because they're not spending their evenings watching my funky face on this, but I can send it to them. I appreciate the feedback. I can tell you with absolute certainty, there's not a group of people out there that care more about providing a good experience than my team. My team is absolutely amazing. And I can't say enough good things about the team, because when you care about serving people and you're bright and you're trying to get better every day, it shows. And so we might not be perfect, but I can tell you with absolute certainty we care, and we live for stuff like that review. So I appreciate you, and hopefully you'll refer all your friends and family, and you'll come back for more loans. We'll serve you more in the future. So thanks, man. Appreciate it. All right, Lady D, thanks for joining. I'm concerned about my home because my mortgage is with Wells Fargo. They recently canceled all loans. Should I be worried that Wells Fargo is going under along with my home? Oh, this is a great comment. I love this because I'm the type of guy that's not going to bash anybody. And as much as I'm a anti-big bank kind of guy, I can promise you that Wells Fargo is not going under. They canceled their personal credit lines is all they canceled. So I think I understood it better too when I heard somebody explain it, where on their balance sheet, they have to have reserve funds in place for these credit lines. So if you have $100,000 credit line and you're not borrowing against it, but Wells Fargo has to have reserves in place for that 100K credit line, it's not smart for them to have these credit lines open because they're not earning any interest when you have zero balance on it. So that's why they just said, you know what? We're going to just cancel all personal credit lines. And that reasoning to me made sense. Whether that's true or not, I don't know. But, you know, the bank as a whole is not going under. Their mortgage department's not going under. So you're fine. You might want to look at a refinance. If you did your loan with Wells Fargo and it's a conforming loan, they've never been sharp on price. So you might be able to go talk to a mortgage broker in your market and get a refinance at a lower rate. But don't worry about them going under. As much as some people would root for that, they're not. Just make sure they're not opening any extra accounts in your name that you don't know about. That's a quiet dig at some of their shady business practices. Kimberly Winkfield. No problem. Happy to help. Good to know that some of this mortgage knowledge that's stuck in this brain is helping people out. I'm under contract with either conventional or cash. Yeah, I mean, maybe Homestyle is a conventional loan though. So you might be okay. Homestyle is Fannie Mae's renovation product. It's a conventional loan. I haven't heard about this flex modification, BOJIM, but for sure I've heard about them offering 40-year terms. So go for it, man. If it makes sense for you, your financial goals, what you're trying to do, payment's going to be super low. Just be careful because on that 40-year term, like nothing's going to principal. So you either want to slap some money towards principal or at least make sure you're using the money you're saving on a monthly basis with that smaller payment and putting it to good use. Because what happens, you know, a 30-year loan, it's bad enough where like the first 12 years, not much is going towards principal. And it might be like 200 towards principal and 1,000 towards interest. Once you get, and it's really not that bad anymore with rates as low as they are, maybe it's 400 and 1,000, right? But you stretch out a little bit longer, that curve, you know, it takes a little bit longer to get that principal pay down kind of rolling. So, yeah, I mean, as much as I love the long-term debt, you don't necessarily want to pay pure interest for 10 years and then, you know, 400 now and 382 10 years into the loan. I don't know if it'll be that drastic or that bad, but it could be. I live in California. Why the builder can cancel my house contract and sell the same spot to higher price? Are you saying why can't they cancel your house? If you're in a binding contract where they're in a contract to sell to you, if you don't go out of contract or that contract doesn't expire, they can't just back out and sell it to somebody higher. That would be bad. Then I'd contact a real estate lawyer for sure. What happens if your house goes under after you buy? I think that's what it's called. If your house like depreciates in value. Good news about today's mortgage terms. You get a 30-year fixed rate loan, your mortgage payment's not changing. So if you bought at 400, if it goes to 430, great. If it goes to 380, great. If it goes to 520, then to 470, like the value shouldn't necessarily matter as much as the terms of the mortgage and that monthly payment and how affordable that is in you and your total budget. I think that's what you're asking. I'm glad that was helpful because I mean that's what I just thought of initially was, maybe you negotiate those terms with somebody. You can go online and there's some really expensive personal loan options. Like what is the name of those? Gosh, I feel like I had a client who, I don't know, personal loan, like unsecured personal loan. You type that into Google and I bet you can find. Let me do it right now. Unsecured personal loan. If you've got decent credit, you could probably get one of these. Lending Tree, Credible. I don't know. Man, dude, online is such a jungle when you're trying to find information. It's like, what's the good stuff? What's the bad stuff? How would I even know? All right, if you got excellent credit, then it's like, who's paying who to be on here? Oh yeah, the APR is like somewhere between 2.49 and 35.99. So you can get a 2% rate or you can get a 36% rate. We're not going to tell you. But yeah, that might be an option too. All right, John W. What were we talking about when you said 2.82%? John W. Oh, we're talking about whether you should wait. I wouldn't wait. I mean, the 2.82 is less relevant or important than what are you currently paying right now? What you're paying right now versus what you're getting. Let's look at that. Let's look at, okay, I'm saving $300 a month. This new loan I'm getting has $2,700 in costs. So that's going to break even in 9 months. And if 9 months from now, rates are at 1.82, refinance again. Armando, I feel you, man. I told him that we slowed down to 40 miles an hour from going 90. And so it's like still home prices are appreciating, but not as fast of a pace. So in Florida, and I think in Phoenix, and I think in some of these other markets that have seen a bunch of, really dramatic growth, you've hardly felt it, right? Because you've gone from 90 to 86. So it's you didn't even take your foot off the gas. There's just a little bit of wind, and it didn't affect your speed very much. So I feel you on that, dude. I think that every market is going to be affected differently in this thing, but you're gonna hopefully see more inventory. A lot of markets have seen it, and it's yet to really have an impact, but over time, I think it will. More increased inventory. My boy Mason Harp. You guys want to know about this kid? This kid won the District 5 championship. This kid hit a dinger in the what were those called, Mason? Like sectionals, regionals, or something? We've got a Little League All-Star in our live stream. Good to have you, Mace. Hope things are good, man. Hope you're having a fun summer. To refinance my mortgage to a lower rate, do I need to show tax returns? You only show tax returns if you're self-employed or you own multiple properties. If you're doing a refinance and you're a W-2 employee, we just want W-2s. pay stubs, mortgage statement, things of that nature. So not necessarily. If you're self-employed or you own multiple properties, for sure, we're going to need tax returns to refinance. No real way around it. There's some streamlined products if you had an FHA to get an FHA streamline, but those necessarily aren't the best option either. So more than likely, you will need it if you're self-employed or own multiple properties. If you're a W-2 employee, good to go. Can you use an appraisal report with another broker if they use the same lender? Huh. No, because they're not going to allow you to flip that loan to a new broker. It's a good question. Flip the appraisal. I mean, I know where you're getting at. What is this? Is this a primary? I'd hate to see a flip on a broker. How far off is it? That's what I would ask. Allow the current broker you're with, say, listen, if I flip this somewhere to another broker, they could save me $1,500. Can you do it $1,500 cheaper? Allow them to match that before you flip it, because it's just I wouldn't want to take that from another broker. I wouldn't want another broker to have to go through that. And to be completely honest, I'm not sure. I'm not sure if UWM, and I do a ton of business with UWM, a ton. I'm not sure if they're going to allow you to transfer an appraisal that they got to a new broker, because you've got a loan locked with them. It's gonna cost them to blow that lock. I'm almost sure that that's a no, but this can't be a primary at that price. $3.169, unless this thing's been in contract for like 9 years. 806 credit. All right, I'm gonna say cash out refinance. Even then, that rate is really high. $281, appraised at $740, locked at 3.16. This is an investment property. I got to know if it's primary investment. I got to know if it's cash out or not cash out. And I have to know whether there's any points at that rate. With all that information, I'll be able to give you some accurate. Okay, Swan Moon. You need a car if it's reasonable with its work against me as far as debt to income ratio goes. It certainly will, because it's all math. Debt to income ratio and how much you qualify for is just 100% math. And so if you've got 10,000 on the income side and you've got 3,300 in current debts, and you're trying to, that's including the mortgage or whatever, you got a 33% back end ratio, you put $1,000 car payment on there, then that goes from 33 to 43%. That was a funky example I used, but if you're on the top end of what you're going to qualify for already, and you add, even if it's a $300 a month car payment, it's going to affect your DTI for sure. So yeah, get that in front of your loan officer. They should be able to give you some guidance there. The only loan programs that you can use without tax returns are bank statement type loans. And there's tons of them out there. They're called non-QM loans. And you can show 12 months or 24 months of bank statements. You're going to pay a higher interest rate. You're going to pay a little bit more in fees, but they're definitely out there. Definitely not, MG. When you get a loan, you definitely don't have to show them every asset you own. The only assets I care about are the ones you're using for the transaction. If you're doing a 5% down, $400,000 loan and down payment plus closing costs is $27,000, if we're not requiring reserves, you give me a bank account that's got $27,000 in it, we're good to go. I don't need to see your 401k. I don't need to see your Fidelity account. I don't need to see the other bank statement where you got $55,000. None of it. Just that the money we need for this transaction, as long as it's enough to suffice for what we need, you're good to go. What do you think about box home loans for refinance? Man, you guys find the I don't like the reviews so far on box home loans. In my opinion, the company is unethical and the underwriters are incompetent. Search also Canopy Loans and Silk Title. Nudge funding. I was told the week before. I'm just reading you guys the first review I'm finding on this one. I was told the week before Thanksgiving I would close in a few days. It's now February of 2021. I locked my rate in September. And they're still unable to close. You will not be able to get any clear answers from anyone there. They also switched my insurance. This is amazing. You asked about it. I did my research. And here's what I found. I'm going to share this with the class. Oh, you know what? It switched it into a bunch of different comments, but this guy even put an update on here, and he said, like, update. It's now 2/18 and working with Canopy Mortgage Box Home Loans. Continue to be a special kind of hell that never ends. Yeah, that sounds. Oh yeah, another person, my refi is going on 4 months. Another person, I'll update once refinance is complete, but we were going on 4 months. The worst refinance experience of my life. Very short, unpleasant experience with this company. Couldn't get the ball rolling. I mean, literally like all these 1-star reviews. When I search box home loans, I think I got to Yelp. So I think that answers your question. And it's another example for anybody who's curious. When I talk to somebody and they're like, I think I got this fantastic rate. What do you think? I say, is rate like the only concern? And you're just going to talk to as many people as you can until you find the lowest rate. Because if so, best of luck to you. And you're really going to find the most unpleasant corners of the universe in mortgage when you're looking for just the lowest rate. You want a competitive rate, and like if box home loans is like, we can get you 2.625, and I'm like, I'm 2.673. I'd use the guy who's got a great team, stellar reviews, cares about his reputation, has a reputation to protect, versus like, what does this company care? They're going to have their 75th 1-star review on Yelp. Whew. I wouldn't do it. I mean, you got to be a special kind of gambler to submit a loan where everyone's saying it takes 4 months and then they don't even do it. Zeta, I don't buy into all this fear mongering that we're going to be a country of renters. Government's going to buy everything and we're all just going to rent. I don't buy it. I don't see it in my day-to-day business. People are qualifying. home prices have gone up, but so have rental prices, and so have wages. I know people are going to argue with me and say that wages haven't increased, proportionally and whatnot, but I just don't see it as bad as some people want to paint it. Mark McDonough, good to see you, brother. Keep doing it, man. You got all the cool videos. You get to do fun real estate videos where you get to walk through cool houses and stuff. I just got to talk about mortgage all day, numbers. Be stuck in my office. You get out there and film $1 million listings. That's the real fun stuff. Welcome, Mace. Good work, man. District 5 champs. My guys. College Glen Little League. Shout out. For those of you that don't know, me and my team were the 89 farm champions. All right, Lamisha. First-time home buyer. My husband and I are frustrated here in North Carolina. Can't find a decent house. Well, it's tough. That's something that's undoubtedly the sentiment for people across the country. Not just in North Carolina, but in Phoenix and in parts of Florida and all kinds of parts of California and all kinds of parts of Idaho and Utah. Just everywhere, it's hard. But I would say don't give up on it. I think things are going to get easier. I feel it and see it in my market, and I would have to imagine the increased inventory, a little bit of breathing room for buyers has got to be happening in other markets too. It's got to be on the way. Miss Taylor, good to see you again. It would be awesome to hear from one of your buyers and their journey in the current market. Yeah, you're right. We should invite somebody on here. We can chat. If anybody wants to go live, I'll add you to the stream. I think that would be cool to do. Owner occupied duplex. Sorry, I'm reading ahead. I'm skipping ahead in the book, and I apologize for that. 2 to 4, owner occ, 806, no cash out. That seems like a lot. All right, we're referencing back to this one, 0.425 points, and you were locked at 3.169. Transfer. I would ask your current broker to do it at a discount. And here's what I would do if I was you. This is what I would do. Good energy in the universe. Right now, it's about $2,500 better. Meaning you could get 294 with 0 points. You could get that 3.16 with a couple thousand in credit versus the cost you're paying. Maybe it's 3,000 better. I would meet in the middle. I would say, listen, I can't justify closing this loan with you that's locked because things have gotten so much better. Can you give me a $1,500 credit, do it at a discount, or else I got to go elsewhere? This specific broker you're working with, my guess is they're going to say, listen, I'd rather not lose money on a deal that I've invested I'd rather not lose it altogether. This deal, I've invested all this time and energy. My team has, locked it, disclosed it, collected conditions from you and all this stuff, and work with the current broker because, one, I don't know if you can take it to the same company and transfer the appraisal. I don't think UW is going to allow that because that's just blowing a lock of theirs. But I also hate to see the person you're working with get ousted. So talk to them. See if they can work something for you. give you a little bit of discount. Maybe they're going to have to do it for half price. You refinance your primary in June? June was last month. Don't buy a new primary in July or August when you just refinance a primary in June. Lenders are going to look at that. They're going to say, mortgage fraud. That's my best advice. Bridge loans are hard. Expensive. And here's the thing. Let's say you own a house that's worth $400 and you owe $250. And you're like, I want to access some of this money. I want to get a bridge loan to buy my house forward. From what I've seen, those bridge loan lenders are like, we're going to cap our loan to value at 60%. So you'd only be able to borrow $240 if the thing was free and clear. You owe $250, you can borrow $0. So they're hard to get in general. You might want to get your house into contract and just write contingent. Might be better than getting a bridge loan. Caden, thanks for joining again. 1031 on our side, we're really not, it's not affecting anything we do. On the real estate side, you've got to get the disclosures out there. This is a 1031 exchange. You got to make sure you have that exchange set up and the monies get deposited directly into that person's account and not, you can't ever touch it or it disqualifies it from 1031. For us, nothing's really going to change. Highly recommend you talk to a 1031 person. If you're in California, hit me up. I got a really good one. But you want to be set up with them completely before you even sell your property, because they're going to connect with title. The money's going to go directly to them. You're not going to touch it. If you touch it, you might be screwing yourself on the tax advantage. What amount of down payment should I put aside in order to negotiate the lowest interest rate? Well, 40% is a magic number where you get a sweet rate, but it's not always the best execution. There's a difference between 40% down, 25% down. Well, 40%, 30%, 25, 20. It's very slight though. Let's say that at 20% down, you got a 2.75. And at 25% down, you got a 2.68. And at 30% down, you got a 2.64. And then at 40% down, you got 2.61. Like, is that enough of a difference between 268 and 261 to put an extra $90,000 down? I'll let you be the judge. Miss Taylor in Washington, and there's more inventory listings, but price isn't affordable for most first-time buyers. Yeah, see, that's the thing, is like it's getting less competitive, but the prices aren't coming down. So that's happening in a lot of markets, Miss Taylor, and I'll forgive you for the typos. What's my opinion buying an overpriced home with cash or with a loan plus down payment? Well, you don't want to necessarily buy an overpriced home. Depends on how overpriced it is. If you're buying real estate as a long-term hold and it's a long-term investment, then, you know, a home I bought last year that we paid $30,000 above list price. Did we pay more than it was worth in August of 2020? Maybe. Is it worth $80,000 more than we paid in August now? Yeah. So do we make up that 30 plus another 80? Uh-huh. Do I feel bad about it? No. Was it a long-term hold where I didn't care if it went up 110 or whether it went down 50 in the next couple years? Yep. So yeah, if it's a long-term hold in real estate and it makes sense for whatever your personal goals are, I wouldn't be too focused on price. I would make sure you get a really good fixed rate 30-year mortgage. But, you know, just by the sound of the verbiage You don't necessarily want to overpay too much. I'm trying to refi an investment property that I own 100%. What would I need? You own it 100%. I mean, it's just yours. I thought like you owe 100% of what it's worth. In that case, a refinance is not going to be very likely. So yeah, basically last 2 years of tax returns, last 2 years of W-2s, mortgage statement, homeowner's insurance, copy of your ID, last 30 days of pay stubs, 2 months of bank statements. Boom. That online application, I'll have you closed up by mid-August. Let's go. All right. Good to hear you're not committing mortgage fraud. I appreciate that. It's good call. Thank you, Caden, for joining. I appreciate you. Do you need to move further than 90 miles away from your primary residence for owner-occupied FHA if you plan to keep primary as a rental? Not necessarily. I've got a video that's titled something like 2 FHA loans at once, and it goes over the exceptions. This is how fast mortgage knowledge comes in. Mortgage knowledge goes out of my brain. Is I can't remember offhand. Family size is increasing. So you had 2 more kids since you bought that house. We need a bigger house. Move 45 miles away. You're all good. That's an exception. You can buy another home less than 90 miles away from your primary as a new primary, right? Another one is you are on the loan and it's you and your father-in-law. He's the co-borrower. Co-borrower is staying, you're leaving. He's staying with this FHA loan, you're going to get a new one. You can get a new loan. What's another one? Yeah, see, you gotta reference my video because I learn it, I talk about it, and I forget it. Okay, yeah, you own 100% and you're trying to refinance. So all the stuff I said, rewind this a minute and a half, listen to that, and that's exactly what you're going to need. I am going to bow out gracefully, an hour and a half. I appreciate everyone that joined. Hopefully you gleaned some value from this. I've wrote down a couple things I'm going to try to get some answers for next week's video. If in the meantime, between time, you have any questions, feel free to reach out. If you're outside of California, it's easy. I've made it easy for you because I get so many people that tell me to connect them with a great mortgage broker in whatever state they're in. And so I just created the website, greatmortgagebroker.com. If you want a great mortgage broker in your state, you just go to greatmortgagebroker.com. You fill out the quick form, connect with somebody who I like and trust, who's going to take great care of you. If you're inside of California, you can go to my website, mattthemortgageguy.com. You can fill out a quick form there. I'll get in touch with you, or just shoot me an email, matt@mattthemortgageguy.com. Me or my team will get back to you as soon as we can. We will give you good, honest advice. If we can help you, great. If we can't, we'll likely try to steer you in the right direction. I appreciate everyone that joined. Hopefully this was valuable. We'll see you again next week, 6 p.m. Pacific Standard Time, every Monday. Thanks for watching.